So uh, let me move forward. So the next question is now we are starting section B. And if you recall our last conversation, in section B, there is no uh, communication related marks. So rest of the three skills we need to demonstrate here as well. Any two in each question. You should assume that today's date is 1st March 25. You should assume that today's date is 1st March 25. The finance director of Clock Limited has requested advice on the corporation tax implications of the following. The sale of warehouse, the sale of warehouse and shares in a subsidiary company, and commencing trading activities overseas via either a permanent establishment or a subsidiary company. By the way, guys, just sharing with you from my own experience, I'm continuously observing since last 8 attempts, or let's say last 10 attempts, based on the students' feedback. In somewhat form or shape, the last few areas of corporation tax, which is about the whether you name it as planning, whether you name it as tax avoidance legislations, for example, thin capitalization, transfer pricing, uh, closed company related rules, CFC, this thing, permanent establishment or a subsidiary. These things are very commonly being examined these days. And when I'm using the word these days, at least I'm talking about last 8 to 10 attempts. So give it a respect. Okay. This information should be used to answer the question requirements in your chosen response options. Clock Limited. Um, Clock Limited prepare accounts to 31st March each year. You know, while reading these type of lines, couple of things which immediately jump or came into my mind. But the first thing which came into my mind is that it is like accounting period is same as fiscal year, no straddling year type of concept. Has forecast taxable total profits from its UK operations as follows. 130,000 in the year ending 31st March 25 before taking account of sale of warehouse and shares in Set Limited. 145,000 in the year ending 31st March 26 before taking account of the planned overseas expansion. See below. Acquire 80% of the ordinary shares in Set Limited on 1st January 2020. Clock Limited and Set Limited are both UK resident trading companies. Clock Limited has no other associated company.
Group loss group and capital gain group implications.
Perfect. And further thing. Very good, Hamza. So in continuation to what you said, since we are talking about the sell of shares in Set Limited, and based on what you picked up, very greatly picked up, that we acquired 80% shares on 1st January 20, and we are thinking to sell these shares somewhat in 31st in the year ending 31st March 25. So it means we have hold the shares for more than 12 months, right?
Yes.
Hence, I can safely say, and since as I highlighted in green, sorry, in yellow, both companies are UK resident trading companies. Based on this additional information, I can think of that while disposal of shares, it might be eligible for substantial
Substantial
shareholding.
shareholding.
Great. So, very good, Hamza. And probably this is basically the thought process which should be in mind while reading out the question. Acquisition and sale of warehouse, by the way, if sold in 31st March in the year end 31st March 25, one additional aspect is we need to be mindful that we have to prorate the upper limit and lower limit as well for the purpose of calculation of corporation tax.
Okay.
Okay. And since it's 130,000 in the 31st March 25, and if upper limit divided by 2. So upper limit is like 250 divided by 2, that's 125. Hence, in the year ended 31st March 25, I can see that there will be no uh, marginal relief available. There will be directly main rate of tax. I hope the points are clear, which we discussed from the first para.
Yes.
Great. Second, acquisition and sale of a warehouse. On 31st March 25, Clock Limited will sell a warehouse to an unconnected person. Clock Limited acquired this warehouse from Set Limited on 1st April 24 for its market value on that date. Set Limited had purchased the newly constructed warehouse from an unconnected person on 1st April 20 and began claiming structure and building allowances immediately. The following information is available in relation to the warehouse. 1st April 20, land building cost to Set Limited, market value, 31st March 25, sale proceeds. Uh, SBA conceptually always remains on cost, whatever is the market value or the disposal proceeds. So, and it's only on the building, not on land element. Set Limited and Coke Limited have used the warehouse wholly in their respective businesses since 1st April 2020. Rollover relief will not be claimed. Acquisition and sale of shares in Set Limited. Coke Limited acquired its shareholding in Set Limited for 440,000 on 1st January 2020. Clock Limited will sell its entire shareholding to an unconnected company for 510,000 on 31st March 25. Clock Limited trading overseas. On 1st April 25, Clock Limited will commence trading in the country of Headlia, either through a permanent establishment in Headlia or by incorporating a wholly owned subsidiary company. The overseas operations will have forecast taxable profits of 30,000 after all relevant deductions for the year ending 31st March 26. Uh, it is expected to remain profitable for foreseeable future. Operating in Headlia through a permanent establishment. This would be
Permanent
clock
establishment
limited
means overseas branch, right?
only permanent establishment, more technical jargon for branch, but like both things are same, interchangeably used.
So,
Clock Limited will not make an election to profit of overseas permanent establishment from UK taxation.
profits and losses will be part of the corporation tax for the clock limited.
Correct. Operating in Headlia through a wholly owned subsidiary company, which would be incorporated in Headlia, would pay an annual dividend to Clock Limited. So just be mindful, if received dividend, that will be exempt because dividend from subsidiaries are exempt from tax. But having said that, one implication would be that this dividend, this subsidiary would reduce the upper and lower limit of uh, Clock Limited for 2026. Would not be a controlled foreign company. So do not think about controlled foreign company. Tax system in Headlia, the rate of tax on profits in Headlia is 22%. There is no double tax treaty between the UK and Headlia. Perfect. Calculate with supporting explanations the increase in Clock Limited corporation tax liability as a result of selling the warehouse and the shares in Set Limited as proposed. B, on the assumption that overseas business is carried on by Clock Limited through a permanent establishment in the country of Headlia. Calculate the total taxable profits in the UK and overseas by Clock Limited for the year ending 31st March 26. On the assumption that overseas business is carried on wholly owned subsidiary, explain the UK corporation tax implications of this strategy for both Clock Limited and the subsidiary. Your answers should include an explanation of the corporation tax consequences. So maybe I'm trying to highlight these words over here. It is not highlighting. I don't know. Professional marks will be awarded for demonstration in analysis and evaluation. Okay, so if I look, calculate, calculate, but if I imagine 9 marks, 5, 14, 6, so somewhat 30% is in the uh, theory and 70% is in the calculation. So so my own advice remains that keep it mix as in the mix of calculation and theory, uh, and keep jumping between the word processor and the spreadsheet. Mm, Part A. Calculate the calculate with the supporting calculations, increase in clock limited corporation tax liability. So supporting calculations for year ending as a result of selling the warehouse. So first, uh, bold, underline, italic, my heading style number one. Mm, the sale of warehouse would result in gains of XX. Mm, okay. So working one, sale of warehouse. Sale proceeds 255,000. 255,000 disposal proceeds.
Structural building and allowance we need to add uh,
Very
to
good.
the disposal process.
Very good. Disposal proceed add SBA claimed. Then I would make a sum of this. Less cost. Cost is like minus 192,000. And as a result, gain. Mm, SBA claimed qualifying cost for SBA. Qualifying cost for SBA was 192. By the way, a quick question. SBA,
The
is it
cost
on,
cost for a cost will
sorry,
be the
102,
market value.
102, 10. No, 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 no. So is it, you are calculating cost 102?
We are
Why I'm
calculating the
taking,
gains for clock, right?
uh,
So we have to take the market value now because the clock has purchased this warehouse from SAT on 1st April 2024. On that date, the market value was 324,
two,
234,000.
hmm, maybe we are missing out something. Uh, Warehouse. On 31st March, Clock Limited will sell a warehouse to an unconnected person. Clock Limited acquired the warehouse from SET on 1st April 24 for its market value on that date. Okay. SET Limited purchased it on 1st April 2020 and began claiming SBA. Now, one thing which you rightly pointed out while reading the question, maybe you are missing out right now. If asset is so, one thing I do recall, you give a comment, Hamza, while we were on this green highlighted line, 80% share. So you made a comment, group losses, group capital gains group, right?
Right.
So any asset transfer within capital gains group is automatically at no gain, no loss,
Yeah, exactly.
right? So since it was at no gain, no loss, hence I am taking up the cost to set limited 102. That's point
Yeah,
number one.
exactly. Right, right,
That's what I'm referring you for this line item. Okay.
right.
For this line item.
Exactly.
But for here, still why I'm going with 102 because SBA remains at original cost. For SBA, there is no such concept of, for SBA, there is no such concept of rebasing or increase in value for cost purposes. So for SBA perspective, the cost remains original cost. Okay.
Right.
Now, uh, for how long that was part of the group? So for how long it was part of the group from 1st April 2020 to 31st March 2025, we are talking about, right?
Right.
So it's like multiply by 3%, multiply by 5 years.
Fine.
So by the way, the points which we discussed, Hamza, while answering this particular point, I will document it. Okay, so I understand like discussion, it's clear to you, and I give always a comment while drafting your answer. Assume it, you are explaining your stuff to the examiner. So if you want anything via, sorry, if to clarify anything, I'm giving you explanation, it means by default that explanation would be part of my answer. Okay.
Okay.
Um, Gain would be 78,300. I'll cover all of my explanations over here. The sale of warehouse will result in gains of 78,300. The following are the key pointers to keep in mind while looking, and that's what I'm not doing it just to explain to you guys at the moment. No, that's basically part of the answer. Okay. The following are the key points to keep in mind while looking for or while calculating the gain on sale of warehouse. Point one, Clock Limited and Set Limited were in a capital gains group since 1st April 2000 2020. Since 1st April 2000 as Clock Limited owned at least 75% of the ordinary shares in Set Limited. Therefore, for tax purposes, the transfer of the warehouse will have been at no gain, no loss. Transfer such that Clock Limited will be treated as if it had acquired the warehouse on 1st April 2020. Second, just to clarify, there is no balancing adjustment for SBA purposes in respect of a building on which SBA has been claimed.
Hello, sir.
Yep,
Please, can you explain this point? Are you saying that
which one?
the SBA allowance that has been claimed will not be adjusted on the cost of the building?
Hmm.
No, my question
No.
is that
Yes, yes, please go on.
my question is that the SBA allowance that has been claimed prior to the disposal of the warehouse, won't it be adjusted from the cost that it was acquired from the capital gain group member?
Mhm. So, Moses, to sum up all of your points, first of all, whatever SBA have been claimed, that all needs to be added back at time of disposal into the disposal proceeds of building. Okay. So this is what I did in the calculation. Now, whatever I did in the calculation, I'm going to explain that at time of disposal, there is no balancing allowance or balancing charge type of stuff in the SBA. So Clock Limited will have continued to claim SBAs on the original qualifying cost. Okay. However, because Clock Limited received the warehouse in a no gain, no loss transfer from Set Limited, the total allowances claimed by both companies will be added to the sale proceeds on this disposal to an unconnected person. Are we clear with the sale of share warehouse?
Yes, yes.
Moses, anything from your side on this?
No, sir.
Perfect. So sale of shares in Set Limited. Uh, do you guys sense about substantial shareholding exemption over here?
Yes.
So then maybe
The
no need
clock
to
has
calculate.
sold the shares of 10% in the last 12 months out of 72 months.
Correct. So then maybe no need to cover it in the calculation. Rather, let's cover it in the verbatim or the discussion aspect. Okay. The gain arising on the sale of Clock Limited 80% shareholding in Set Limited on 31st March 2025 will be exempt from corporation tax. Why it will be exempt from corporation tax? Under potential shareholding exemption. This now, so first I give my verdict. Okay. Now I'm going to justify my verdict. So first I given my verdict. Now I'm going to justify it. This is because Clock Limited owned at least 10% of the shares in Set Limited for a continuous period of 12 months during the six years prior to sell and Set Limited is a trading company. Now, last.
Do we have to
Increase.
justify whether Sat Limited is a trading company or not?
Is it a prerequisite for SSE? Condition for
Mm,
SSE?
no,
The answer is yes. Oh, the answer is yes.
no, I
So,
didn't get
okay.
it.
Mhm. So in this line, what I'm doing is, if you notice, I'm putting down the conditions or linking the conditions from the scenario, right?
Exactly. Uh,
Uh, my question to you is it a condition for the company to be trading company, or that's not a condition? So if it is a condition, then I need to mention it. If it's not a condition, then no need to mention it. So that's a principal statement. Now let's look whether is it a condition or not. Okay.
okay.
Um, just a sec. I'm opening up the file. We are talking about SSE.
It is considered to be a condition for the clock limiter, right? When whether set limited is a trading or not.
So I have opened up the unannotated notes. Should be above, after, before straddling here.
Yeah.
So after this, probably that was after. Here we go.
Yeah.
So look,
Both.
conditions. So maybe I from my end I missed to mention clock limited.
Hmm. Both.
Okay.
Okay. Okay. Okay.
Uh, and sorry, I can see there is a comment. Okay. Increase in corporation tax liability. So let's start the increase in corporation tax liability. The total increase in clock limited taxable total profits for the year ended 31st March 2025 will be 78,300. For the accounting period ending 31st March 2025, Set Limited is an associated company of Clock Limited. As Clock Limited will have had a shareholding of more than 50% throughout this accounting period. The upper limit for augmented profits for determining the rate of corporation tax payable for the financial year 2025 will therefore be clock limited, taxable trading profit, sorry, taxable total profit prior to making these disposals were forecast to be 130,000, such that it would already be paying corporation tax at the main rate. Accordingly, as a result of these disposals, there will be increase in corporation tax of 78,300 into 25%. 19,575. Is this part clear?
Clear.
Thanks. Moses, anything from you?
Actually, the question say that what should be the additional increment on the taxable liability? But I can say that more information is provided in the answer, like the upper limit for augmented profit. Although I'm fine with the answer, it's just this additional information. I'm just wondering if it is required.
So again, the word was calculate with supporting explanation. So without explaining why you are taking 25%, so in the I would say 3 paragraphs of this heading, I simply explained why I am what I'm going to do. And uh, in the last step, I just executed whatever I discussed. So it's like, starting 3 paragraphs are the planning, and the last paragraph is simply the execution. Okay. A requirement. B1. On the assumption that overseas business is carried on by Clock Limited through a permanent establishment in the country of Headlier, calculate the total tax payable by Clock Limited. Overseas business is carried through permanent establishment.
Calculate total tax.
Okay. Calculate the total tax payable by Clock Limited for the year ending 31st March 25. The total tax payable is mm, okay. UK trading profit.
145.
What was the Headlier profit? Was 30,000. As a result, total taxable profits 175. Now, if I look over here, what should be the corporation tax rate? Should it be straight 25? No, it should be with the marginal relief. So 175 multiplied by 0.25, 43750 less marginal relief. Marginal relief is 3 upon 200 multiplied by 250,000 minus 175,000. multiply by 175 divided by 175, because here I'm assuming that taxable and augmented are same. So that thing works out to be 1125. And I'm going to copy this formula over here for reference. So 250,000 minus 175, 175 divided by 175. 1125 and putting apostrophe 4625. Sorry, 42625. DTR, I'll calculate the DTR. I'll calculate the DTR and then it would be my double tax relief would be lower of UK tax and Headlier tax. So Headlier tax, I do recall that was somewhat 22% if I'm not
22%.
recalling.
22%, yes.
So it's 30,000 to 22%. And for UK tax, first maybe I need to calculate the, I would use the word effective tax type of stuff. So it's 30 divided by 175 multiplied by
In case of marginal relief, we have to do this, right?
yeah, otherwise your rate of tax remains the simple thing, right?
Remain the same, right? Yes.
So copy this one. Mm, 30,000 divided by 175 divided by 42625 with the minus sign. So UK corporation tax payable and okay, now heading towards here. The total tax payable is, what was the amount? Sorry, 36025. 36025 42625. Yes, Moses.
What is the concept of the marginal relief? What is it all about, please?
So, Moses, the concept of marginal relief arises if your augmented profits are above the lower limit of 50,000. Then there is a concept of marginal relief. And if your augmented profits are above uh, upper limit of 250,000, then there is no marginal relief. So, sorry, let me rephrase in one go. If your augmented profits are in between upper and lower limit, then there is a concept of marginal relief. And if your augmented profits are straight away uh, more than the upper limit, which was like, let's say, situation in the year ended 31st March 25, then there is no concept of marginal relief. Mm. Is it done? Great. Following the disposal of shares in set limited on 31st March 25, clock limited will have no associated company in the year ending 31st March 2026, such that
But if the shareholding would have sold, let's say on second
1st
week of the
April,
April 2026, then we have to
mhm,
consider it as a part of the
yes, so
system
even
for
if
the
you
full
say
period.
second week, I would say even if it's on 1st April, then I have to
Yeah,
count it,
yes, exactly.
such that upper limit for augmented profit for determining the rate of corporation tax payable for the year ending 31st March 2026. Okay, so that's important to write because that is to clarify the doubt why, like in part A, we prorated the limit. In part B, why are we not prorating the limit? So that's why it's important to clarify over here, in my view. B2. On the assumption that overseas business on the assumption that overseas business is carried on wholly owned subsidiary of Clock Limited Incorporated in Headlia. The overseas. Okay. Explain the UK corporation tax implications of this strategy for both Clock Limited and its subsidiary company. Okay. So the explanation is not only towards, let's say, one liner, it's both the sides. Your answer should include explanation of corporation tax consequences of the receipt of dividends from the subsidiary company. So you should include something about receipt of dividend as well. Sorry. The subsidiary company would be an associated company of Clock Limited for the purpose of determining the rate of corporation tax payable in future accounting periods. As Clock Limited taxable total profits are forecast to be 145,000 for the year ending 31st March 26. They will exceed the upper limit of before considering any dividends received. Due to this, Clock Limited will corporation tax again at main rate Uh, is my first point clear?
It's clear.
Mhm. I just noticed about the, sorry, 7 comments. So let me look before I proceed. Hamza, I just read your comment about the RDC. So just give me, let's say, maybe 5-10 minutes more. Let me done with this question, then we'll discuss about your concern about RDEC. Okay.
All right. All right.
Mm, Moses, anything from you on this?
No, sir.
That's
Just that
great.
the concept of marginal relief is new to me. So I
No,
have
no.
to
Why
take
it
time
should
to.
Moses, it should not be. This concept exists since last 3 odd years. So it should not be.
I think I wrote it yes more than 3 years ago.
Oh, if that's the case, then fingers crossed, my friend. Okay. Now any further point? So just there are 6 marks for this, and since it carries 6 marks, so according to me, it should be bare minimum uh, three very solid. Very solid means 2 marks, 2 points each, or bare minimum uh, 6 points. So if you look in my first paragraph, I'm basically addressing 2 points. One, rate of tax, and second, the reason as well why it would be main rate, like the discussion of associates.
Okay, I was thinking that if the company is treated as a subsidiary, it should be excluded from UK tax.
Oh, yes. But since, so in while counting the associate, do you count only UK resident company or non-UK as well?
Okay, okay. From consolidation point of view.
So I have opened it, right? Good job. So first of all, so that it's good, it's open. So this is upper limit, lower limit, standard fraction, marginal relief, how to calculate, all these type of discussions. First. Second thing is about associated companies. Uh, Read out these 4 bullets and in particular the last bullet. Therefore, companies which are overseas resident can be included. Rather, the wording should be which are resident overseas must be included. So, Moses, I personally feel, based on what you just said or what you just asked, uh, the marginal relief is a fundamental of corporation tax. It's like, uh, don't take me wrong, my friend, but just a piece of advice. So, if you are struggling with this marginal relief thing, then maybe from a individual taxation perspective, it is equal to you are struggling with the application of tax bands. And if you are struggling with the application of tax bands, uh, I would say just one thing, maybe not a good sign considering, let's say, 2 weeks, 3 weeks before the exam.
Okay, I will review it. I will revise it and to make sure that I'm up to speed. Uh,
Not not high level, keep it that at detail level.
okay. I have another question because when we are looking when I read this the branch maybe running the overseas company either as a branch or as a subsidiary.
Mm.
When we try to compare the both, they often say that if you decide to opt for a subsidiary, it means that the profit will be excluded from the UK tax. And not only that, you will not be able to get the loss relief in the UK and some other relief that is applicable. But in this case, if you are running the company as a subsidiary and is being taxed, or is it because of the associate part of it that's subjected to UK tax? It's a little bit not too clear at this point, because if he decides to run the overseas company as a subsidiary, by implication, it should be excluded from the UK tax because it's going to be taxed in the home country where the subsidiary exists.
So on this, Moses, there is no UK tax on the overseas subsidiary. Okay. Okay. So I repeat, the profits will be subject to UK corporation tax, and we are talking about subsidiary if it is a UK resident company. And if non-UK resident company, the profits will not be subject to UK corporation tax. However, there are certain implications, let's say the implication of associate, etc., etc. But other than the this thing associate, there are no other impacts. There will be no, you cannot adjust the loss, you cannot take the loss, you cannot adjust your capital gains. You are not supposed to pay UK capital gains, UK corporation tax on gains overseas, no UK capital allowance on overseas, nothing. Only the limits element because it's a subsidiary, separate legal entity. I'm just trying to write is the profits of the overseas business will only be subject to UK corporation tax if the subsidiary company is tax resident in UK. Company is referred as resident in UK if accordingly. Last paragraph. One thing question very categorically asked to me about the discussion on dividends as well. Any dividend received by Block Limited from the overseas subsidiary will be exempt income for the purpose of UK corporation tax. That dividend will also not to be included in calculating augmented profits or clock limited as we have to include only dividends from um and done. Yes. Anything to ask? Anything to clarify?
All clear, all clear.
Thanks. Moses, anything from you?
No, sir.
Great. So I'm about to save close this file. And then let me look for Hamza. I do recall you had one query. So first let's look to
Yes.
your query and then we'll start the next part. Okay.
Okay.
Mm, yes. So your query was around RDC, research development.
Yes, in
So
the corporation
what's
tax, we have discussed about this topic, and on the qualifying expenditure, we have to add back the 20% to the profits, right? And then the same amount is allowed to be deducted from the final corporation tax liability, resulting in an effective tax savings of 15%. So, what if our corporation tax liability is less than the tax credit of the RDC? Because there is a situation, there was a situation in the question I was solving. And what if there is a trading loss instead of trading profit? So trading loss will be reduced, obviously. You add
Correct.
the 20% of the RDC as a income, right? So the loss will be reduced, but you don't have the income tax liability to adjust the RDC credit. So what are the implications in these two situations?
So maybe the question which you have asked, I just highlighted.
Mm,
Let me do it normal. Where the available tax credit exceeds the company corporation tax liability. So this is to be precise your question. Where the
mm,
tax credit is exceeds the company corporation tax liability, then what will be the consequences?
mm,
The remaining amount of tax credit can be, means there would be no negative. Rather, you can reduce it to nil, and whatever is the amount exceeding the liability, what you can do with that? Carry forward and offset against the company corporation tax liability of future accounting periods. Option one, two,
mm,
or in case of a group company surrendered to another group member of the group or paid to the company. There is a cap on the amount that can be used in these alternative ways. The cap is not examined. So there are restrictions, but restrictions like uh, put it on
So,
side.
let's say I'm assuming that the corporation tax liability is 50,000 and whereas the tax credit is 80,000. So the 30,000 I can surrender to the companies within the group.
So option one, you can carry forward against your future profits.
Yes.
Second, you can surrender to the group. Third,
And
you
if
can request
still remains,
HMRC after adjusting to the group.
yes, we did the option two, and if it is still remains.
So then you have two further options. One, you can carry forward.
Mm.
Two, you can request HMRC to give this cash back to you, like the third bullet,
Okay,
paid
okay,
it to you.
it will be refundable. Okay.
Yes,
Sorry,
perfect.
got it, got it.
No worries, man. Uh, Anything further, or should we start the next one?
One more thing. Uh,
Mm-hmm.
when the person is treated as a temporary non-UK resident and purchase the asset after leaving the UK and dispose the asset before coming back to the UK. So the
Exempt
gain,
from UK
uh,
CGT.
yes, exempt from the UK CGT. But if there is a loss, so the loss is
Exempt, exempt.
not allowable, right?
Yeah. So you
Uh,
can say that asset becomes exempt asset, like motor vehicles, SSE. These are exempt asset. If an asset is exempt asset, any gain is not chargeable or taxable, and any loss is not allowable.
got it. Right. So,
So one thing, gain exempt is something else, and one thing is asset become exempt is something else. For
mhm,
example, in capital gains, the page, starting page or the table of exempt assets, that is
mhm,
exempt. Whether they result in gain, whether they result in loss, exempt means exempt. For example,
exactly.
SSE, we just did the question. SSE, if conditions are met, 6 out of, sorry, 12 out of 72, both companies are trading, then the shares become an exempt asset. And if an exempt asset, so if you notice in my part A solution, I do not give a care whether it's creating a gain or creating a loss. I just discussed it's meeting SSE, full stop. No need to consider any capital gain.
Hmm.
And that's the case with most of the exempt assets. So for example, we do discuss we do discuss about transfers on death. Transfers on death, whether gain loss, exempt from capital gains. Okay,
Okay.
perfect.
Thank you.
So let's start another question. You should assume that today's date is 1st April 25. Adil and Chitka have requested advice in respect of the reduction in their combined income tax liability following the transfer of an income producing product, income producing asset, the availability of gift holder relief on a gift of shares, and the consequences of making such a claim, and the availability of business property relief and maximum potential inheritance tax liability which may arise on a gift of shares. The following exhibit available on the left-hand side provides the information relevant to the question. Adele and Chetka. Okay. Adele and Chetka are not married but have lived together for many years. Are both tax resident and domiciled in the UK. So, guys, just for reference, I hope I was clear while discussing the overseas aspect that the
Hmm.
concept of
The,
domicile
the
is now abolished and replaced by the concept of long-term resident,
qualifying.
qualifying long-term residents, right? So
Yes.
for long-term residents, it's basically as good as domicile for your exam purposes or for your past paper type of purposes, domiciled or deemed domiciled. Although these things are conceptually different, I'm not saying that these things are conceptually same. These things are conceptually very different. But just to avoid the doubt, you can think of them as same. Okay.
Hmm.
Adil will have total income in the tax year 25-26 prior to making any gift to Chitka as follows. Trading income, 55,000. Rental income from a UK investment property, 15,000. Dividend income from Buvik Limited, 12,000. Dividend income from other UK companies, 8,000. Will gift either his UK investment property or entire shareholding in Buvik Limited to Chitka on 6th April 2025. Has made one previous lifetime gift to his daughter on 1st July 22, which resulted in a gross chargeable transfer of 108,000. Okay. Chitka will have income from employment of 14,000 in the tax year 25-26, which will be her only source of taxable income in this year. Will retire from his employment on 1st March 27. Will sell the asset received from Adil on 1st March 27 when it is anticipated to have
Increase in value.
increase in value. The Adil shareholding in Buvik Limited. Adel required 10,000 ordinary shares. Adel acquired 10,000 ordinary shares, 12% holding in Buvik Limited on 1st March 23 for 386,000. The market value of these 10,000 shares on 6th April 25 was 404,000. Buvik
Imported.
Limited is a UK resident, unquoted trading company, owns assets which have a total value of 4.5 million on 6th April 25. These assets comprising trading assets valued at 4.1 million, of which 3.8 million will represent chargeable gain for CGT purposes, and shares in an quoted company valued at 0.4 million held as a long-term investment. Uh, so if you can join the dots, so if we talk about, let's say, holdover relief, and if we talk about, let's say, BPR, then it would not be straight away the 100% element, because this company has some accepted assets, or I would say some non-business assets in easy words.
Hmm.
Okay.
Okay.
Requirement. Calculate with supporting calculations which of the two potential gifts from Adel to Chitka will produce the greater which will produce the greater annual income tax saving for the couple. On the assumption that Adel gives his shares in Buvik Limited, explain why gift holdover relief will be available for the purpose of capital gains tax, and explain with supporting calculations of the impact of making a gift holdover claim on the chargeable gains, which will be realized by both Adla and Chitka. On the assumption that Adel dies before 6th April 23, explain the availability of DPR in respect of the gift of his shares in Buvik Limited, and explain the specific circumstances in which the maximum inheritance tax liability would arise in respect of this gift, and calculate the amount of his liability. Professional marks will be awarded for analysis, evaluation, skepticism, and commercial acumen. Okay, so Hmm. Uh, Calculate with supporting calculations, which two of the potential gifts? Hmm. Net tax saving, net income tax saving due to potential gift. By the way, some of the things to confirm. His income is 90,000 and Chetka income is 14,000, right? Adil is a higher rate taxpayer. Total annual income of 90,000. And Chetka is a basic rate taxpayer. Total annual income of 14,000. In respect of both gifts, in respect of both gifts, the full amount of the transferred gifts would fall into the higher rate band for Adil and would fall into the basic rate band for Chitka. The income tax savings as a result of would be Gift of UK. Investment property. Gift of shares. Working one. Gift of UK. Investment property. Tax saved from Adil. 15,000 into mhm, additional tax to Chitka. Mm, 12,000 multiply. Tax save from additional tax to Chitka. Did Chitka already had any dividend income? So Chitka has, I do recall, 14,000 of income, right? Income from employment. So you know why I just checked this and what difference does it make to me? So let's 3,000 and 30 double. Hmm. Anything which in your view requires explanation? So one thing which is in my mind, Adele has other dividend income, which will utilize the dividend nil rate band. So this will not be lost. Chitka has no dividend income. So dividend nil rate band will be available to reduce the amount of dividend which is taxable at 8 percent. Therefore, gifting the shares in Buvik Limited will lead to greater net annual for the couple of 3000. Mm, um, I'm heading towards the requirement again. And if I look into the requirement, on the assumption that Adil gift shares in Buvik Limited, Mm, two-way method. Why gift holdover relief will be available? Yes. Why gift holdover relief will be available? 2 marks, 2 points.
It's a UK resident company.
Good,
It's also a trading company. It's unquoted company.
good, and good, and rightly said, but missing one more point.
It's a business asset. It's a qualifying business.
Yeah, so maybe that's you covered in the first point, no? Okay, I'll not take much of your test. So sweet and simple, 2 points. Because two-way method is an unquoted trading company and Chitka, the Doni, and Adel, the donor, agrees to claim the relief. So that's a simple answer. Two conditions. Unquoted company shares are business assets. So first I referred that. Mm, shares of unquoted company is business asset. Second, Explain with supporting calculations the impact of on the chargeable gain which will be realized on the chargeable gains which will be impact of consequences of gift holdover relief for both Adel and Chitka. The gift of the will give rise to a chargeable gain to realize chargeable gain for Adel of how much? Adel equal for 386 and 4440. Market value minus, I can sense that to be 18,000. However, since Wick Limited is unquoted trading company, hence the gains will be eligible for gift holdover relief. which restricted to which will be restricted to business assets of Ubik Limited. This is calculated as the value of chargeable business assets divided by total chargeable assets. Accordingly, Ubik Limited has into 100%. Hmm, 3.8 divided by 4.2, right? 90.48, 90.48 0.48% of chargeable business assets. Hence, the gains of 16,286 out of 18,000 will be deferred and remaining 1714 will be chargeable. the deferred gain of 16286 will be deducted from the base cost of the shares for Chitka. Consequently, when Chitka sells the shares on 1st March 27, the gain realized by her will be effectively increased by the amount of the gift relief. Um, are we clear with the 2 and 4, the total of 6 marks of discussion with respect to capital gains? Two and 4, the total of 6 marks. Any question? Any question? Just a second, let me change my headphones. Okay, will be amount of gift relief. See, on the assumption that adult dies before 6th April 32, explain the availability of BPR in respect of the gift of shares. Adult dies before availability of BPR in respect of gift of shares. Yes, so a sweet and simple question. Would the BPR be available? The answer is yes. But again, the discussion of accepted assets The gift of shares will qualify for BPR at the rate of 100% because UVIC Limited is an unquoted trading company and Adil will have owned the shares for at least 2 years prior to the date of gift. However, the relief will be restricted to business assets. However, the relief will be restricted business assets the relief will be restricted to business assets in the company due to non-business assets, i.e., shares in quoted company will be restricted to mm, 4.1 divided by 4.5 multiplied by 368,089. However, it is also necessary that Chikta owns the shares at the date of Airtel death, or if not, or if not, that share has reached the proceeds in qualifying replacement asset, replacement business property. As Chitka will sell the shares on 1st March 2027, further information will be required as to whether or not a qualifying replacement asset is acquired before so that is, you can say, the complete discussion on the availability of gift holder release. So why I covered this part as well, because this is fundamental on the availability, that shares are still held by Chitka. Now let's look toward part two. Availability in which maximum will rise in respect of this gift and calculate maximum potential IHT liability. So next discussion is around maximum potential IHT liability. The maximum IHT liability will arise if adult dies after 1st March 2027, is BPR no longer available if Chitka does not acquire a replacement asset. As she made a gift as she has made one prior gift of 2022, which will use part of his nil rate band if he dies prior to this date. And before 6th April 2028, years after the gift date of 6th April 25 as taper relief will be available after this date. Annual exempt amount, annual exemptions are available for the tax year 25-20 and 24-25, such that the gross chargeable transfer gross chargeable value of the gift will be the maximum potential IHT liability is therefore 398,000 minus 325 minus 108,000 multiply by 40%, 72,400, and will arise if adult dies between 1st March 2027 and 6th April 2028. So I'm done. So I hope this discussion would also be clear. That is like, I can tell you, interesting discussion, interesting conversations, very interesting discussion and conversations. In fact, uh, so if any concern, any query, do let me know. Otherwise, I'm done with this question as well. And by the way, there was very little use of calculator in this question, right? So I'll upload these questions. And if you have any feedback from the questions from anywhere, please do let me know. Thank you very much. I'm keeping it till here for the day. We are done. So I understand if we start any other paper and the question will not be able to complete it. So that's why we are keeping it till here. Okay. Thank you very much. Take care. Allah Hafiz. Goodbye.